Chapter 5 is on control activities. It also is on fraud and the proper handling of cash. We have petty cash and we have cash in the bank account from which we're going to write our checks. This chapter, what I would say about it is if you have an interest in these topics, you could take a class, an entire class devoted to fraud. In fact, we have a program here at Pittsburgh State that is a fraud and forensics program, and you could also take classes relating to controls and understanding internal controls and establishing accounting systems. So how you would set up an accounting system for a company. And this is commonly called accounting information systems. So this is just a bit of an introduction to these topics. You could take any number of classes in them. This is just a general overview. There's going to be 3 audios on this. The first one is going to be about fraud and control activities. The second one will talk about petty cash, and then lastly we'll do our bank reconciliation. Everyone should know how to do a proper bank reconciliation. I know many of you probably just wait till you get your bank statements and then briefly look through the bank statement to see if it's right. And when you want to know your balance in your bank account, you go to the ATM and you maybe are withdrawing funds, and you'll also ask for your bank balance. But there's actually procedures in the way that companies do bank reconciliations and the way individuals should be doing bank reconciliations. That will be covered in the third voiceover. So fraud, what is fraud? It is an intentional act to provide for personal gain at the expense of others. It has to be intentional. There has to be a desire on the part of the individual, who is called a fraudster, by the way, to deceive. They have to have this desire to deceive others for their own gain, and so for fraud to have occurred, this individual, this fraudster, must have gained from it. They gain something from it, and their gain is from taking away from others, or as we say, at the expense of others. Fraud happens a lot in businesses. Sometimes fraud is a very small amount in relation to the financial statements of a company, and a company knows it exists, but they know that it also takes money to go out and prosecute or to find the individuals involved. We had an example early on of a merchandising firm. Fraud occurs quite often with the individuals who are selling the merchandise. They can take merchandise home, they can take cash from the cash drawer. This is an intentional act, and they're going to try to gain for themselves, and it is at the expense of others. It is at the expense of the company, because they're either stealing merchandise or they're taking money from the till. Now we have a fraud situation happening that is involving credit cards. So credit card fraud, identity theft. This is an example of, again, an intentional act to gain for yourself at the expense of other individuals. The theory behind fraud, the most popular theory behind why companies have to see fraud or fraud exist, is that there exists this fraud triangle of incentive, opportunity, and rationalization. Incentive means there's something to be gained. So if you want to limit the likelihood that fraud will occur in your business, take away the incentive. There is an opportunity. Now you might think, well, incentive and opportunity, aren't they the same thing? Incentive is really talking about what the gain is. So if you reduce the gain, then hopefully you'll reduce the fraud. The second one of opportunity means let's take away the opportunity so they can't take it. We don't have the high ticket items displayed. We have them behind a display case that's locked. So there's no opportunity for the individuals who are coming into our shop to shoplift because they can't take those items easily. Take away the incentive. Instead of putting out the items that are high ticket, give them a little sample. Let them look at the sample. And there's nothing to be gained by them stealing the sample, but there may be something to be gained from them taking the bigger item that's not available. Rationalization is the process in which the fraudster tries to say, well, what I'm doing isn't a bad thing. An individual who shoplifts may say, well, I will never have enough money to buy these things, and I know that this business, I have worked in retail, I know that shoplifting occurs, and I don't think it's a bad thing because I know a lot of people are doing it. So rationalization is really the mind game that the fraudster has that tries to say, it's not so bad. It's not so bad what I'm doing. Oftentimes an individual that steals from their employer, for example, will say, this employer did not pay me the overtime they owed me. This employer treats me bad. Because the employer treats me bad, I can be all right in doing this thing. I can take this thing because I'm treated bad. So the notion here is that if you want to eliminate or reduce fraud in your business, then you should do something about the fraud triangle. That's the approach that you should have. Well, most of you have heard of Sarbanes-Oxley, or SOX, I believe. It came about as a result of Enron and other frauds that happened within companies. And one of the types of frauds that you can have is when a company intentionally misleads by creating financial statements that are erroneous. They are misleading. And the gain that they can have from it is oftentimes increased compensation for CEOs or CFOs who get stock options. So they dummy up their financials. They make the financials look better than they should. This is committing fraud because it's intentionally misleading investors, telling them that they should invest in this company because it's a strong company when it isn't. And the gain that comes out of it is again from the CEO or CFO's income. So their personal income can be derived from stock price, which goes up, and it benefits them. Sarbanes-Oxley then was an act to counter all this financial reporting fraud, and when it was adapted or taken on, the studies do show that it tend to be effective in some ways. So what we want to do here is to use it and try to relate it back to that fraud triangle we were talking about. And the incentive for doing fraud was taken away because now there's going to be punishments associated with it. The CEOs or CFOs will have to pay stiff fines, they'll have prison terms, and also it will become more obvious they're committing the fraud. There's going to be more reporting of the fraud, so no one would hire them as CEOs or CFOs. And the SEC can take sanctions against these individuals so that they'll never be able to serve as an officer of a corporation again. So these fines and prison terms will tend to counteract any of the positive incentives, any of the gains that they would have from committing financial reporting fraud. Also, one of the changes within a company is that the audit committee, which is a part of the board of directors, was strengthened. So the board of directors has more insight into what's happening in the company, so they can look over what's happening, which reduces the opportunity for the CEO or CFO to do whatever they want because there's more oversight. And then there's also more discussion of ethics, a use of the ethics codes within companies, uh, the establishment of whistleblowers protection, and we are paying rewards for whistleblowing, and this is encouraging honesty and bringing more importance to the importance of not committing fraud. And so less easy to rationalize fraud, less easy to say that fraud is all right, it's okay to commit fraud. The essential internal control can really be taken down to an acronym then. What is internal control? And internal control are the policies that the company have and the procedures that try to encourage the employees to adhere to a set procedure or a policy that's established as the company's goal. And efficiency, it's an efficiency of operations, the best way to conduct operations so that most is accomplished at the least cost. We want to minimize the theft and errors that are occurring. Notice we don't really say minimize fraud. We're saying minimize theft and errors, and we want to enhance the reliability and the accuracy of the accounting records in what we're doing. So we have policies and procedures under Peter, and what we're trying to do is promote operational efficiency, try to minimize theft and errors. Now you can't eliminate theft, you can't eliminate errors, you can't eliminate fraud. You just try to minimize those things. And you also try to have accounting records that are reliable and accurate. And again, you cannot ensure that there will be no errors. You can't ensure that everything will be 100% accurate. We can't do that. Some of the objectives then in setting up internal controls are that we should be trying to safeguard our assets. We safeguard the assets so they won't be stolen. And then we try to maintain a system so that when we have our accounting data, it's right. When we do our journal entries, we're doing them for the right amounts. And that they're not compromised. Someone from the outside can't get in and hack into our system. We have efficient operations. Everything's done quickly according to schedule. We have those policies and procedures in place. And if management says something's going to be done a certain way, it's done a certain way. So we are trying to encourage compliance with the rules and with the regulations. So these are an internal control objectives. So we can talk about the safeguarding of assets. It's something you probably can all relate to. What is meant by this? Well, we need to think of it as something more than just, say, the automobile, as the examples are down here, making sure that the automobile is not being stolen, for example. Yes, that's a safeguarding of asset. But we also need to think of the accounting records as being an asset in themselves. Even though we don't record them in a journal entry, we need to think of our accounting records as having value, and that we should try to safeguard those. Safeguard those, again, from access from other parties. If we're going to talk about automobiles, one thing you should do is you could keep your automobiles locked up. You should only let certain people get to the employees use the automobiles. They should be signing out the automobiles when they're driving the automobiles. It should be for a business purpose. Our company records, when we do our fixed assets, when we do a journal entry for fixed assets to bring it on our books, we're debiting fixed assets, say, and we're crediting cash. When we do that journal entry, we should do more than just the journal entry. We should keep records that describe what it is, where it is, the serial numbers. We should have insurance on these vehicles. And anytime we sell an asset, it should be triggering an update, and so we know that the assets are sold, so we have an accurate inventory of what the assets are. When did we buy them? What's the description? What's the serial number? Who can use these assets? Where's the location? In a big corporation, a major factor is location of the asset. Which Walmart store has this particular cash register? And if we do decide to sell the automobile, and we talked about fixed assets, we said they were sometimes sold and not generally at the date when we estimated, but at a date when they're no longer useful. Well, who determines when they're no longer useful? Who determines the amount that they can be sold for? What's an acceptable selling price? So there's an approval system all along with this safeguarding of assets, and all of it should really fit together. So you have record keeping, you have assets that are being safeguarded, You have authorizations in place to keep the asset from being misused or stolen. There's just a lot to internal controls, and as I said before, there's a whole class in this that you can actually take. Here are 5 common principles of internal control. You have to establish responsibility so your employees know what items there are, things or duties they're responsible for. So a person who is a cashier will be responsible for their drawer, right? Only their drawer. They get their new drawer every time they come on shift. I'm sure you've seen this at Walmart. Someone is at the drawer and they're exchanging, or they're taking out the cash drawer and they're putting a new cash drawer in. That's because that particular employee is only responsible for that cash drawer. A segregation of duties. So what you need to do is you need to separate all the functions that are going on within a company. And we often refer to this as record keeping, authorization, and custody of assets. So the person doing the accounting record shouldn't be the one that also has custody of that particular asset account. A person who's doing the bank reconciliation shouldn't be someone that's handling cash. A person who is handling inventory shouldn't be the person who is also doing the journal entries for inventory. So we call that ARC. And restricting access. So accounting people shouldn't be in the inventory. And if you have an accounting system that is a computerized system, you'll probably have passwords and firewalls to protect access. As we said before, safeguarding of assets includes the safeguarding of accounting records. And you have documents. Documents are really important. One thing that companies do is they pre-number their documents so they know if a document is missing. And the documents, when we use them, we need to keep copies of them. It could be electronic versions of these documents, but we need to have a version of the documents available. And again, if you take an accounting information system, you'll learn about all the documents that are involved in accounting, from invoices to purchase orders to checks. You'll learn about all of that. Independent verification is important. So you need someone to check the work that your employees are doing. If you have an individual in accounting and they're doing bad work, you need to know they're doing bad work because you want to minimize the errors in your accounting system. And one way to minimize the errors is having people check each other's work. One good way to check one thing here that you might think is kind of strange, but a company that sends out invoices and bills people, well, they are making the other party really provide this verification, because they'll send out an invoice to someone billing them for an amount, and if their accounting system is wrong, that individual who's being billed is going to call in and they're going to say, "You got it wrong. My bill is wrong." This is the type of independent check and verification that's coming from outside, but yet it's someone that's checking the work. It's checking the work of the accounting system. So establish responsibility for employees, who does what, and make sure they are only doing what they have responsibility for doing. And that involves 2, which is segregation of duties and keeping the lines separate. So custody, authorization, record keeping, all kept separate. And don't let anyone have access to all the accounts, to all the assets, all the information. You need to put it along clearly the lines of who needs to have access to these things. If it's a computerized system, you have firewalls, you have passwords. You have documents, you use pre-numbered documents, you keep copies of the documents. And documents serve a purpose. I often say if there's no document, it didn't happen. And then provide a way for individuals to check each other's work. And it's not so much an individual looking over the shoulder of someone and duplicating their work as a way to check numbers. Check numbers, see the numbers are right. Someone else, before you write a check, you're going to double check the amount. Make sure that amount is right. That's an independent check and verification. All these internal controls can never completely prevent and detect the errors or the fraud. Anyway, I said earlier, it's to minimize the errors and theft. It's not to completely eliminate it. And one of the problems here is anytime we have a control, the benefits must exceed the cost. Have you ever been into a store and they put one of those white plastic devices on that supposedly if you try to take it apart, the ink is going to fly all over and the merchandise is going to be ruined? Well, have you ever seen one of those tags on a low ticket item? Occasionally it happens. Occasionally I'll see an item and the item is selling for $3 and there'll be this tag on it. Well, if someone were to steal this $3 item, probably that store would lose maybe $1.50. But having the tag on the item means that the clerk has to remove this item. It means the clerk has to put on the item. It means that the clerk has to have this device. You have to buy this device to have it available and keep it operational. There are a lot of costs. Besides that, if the customer goes home with the device on the item, then the customer is going to be angry because they're going to have to make a special trip back to the store. So this is an example where the cost of creating that control by having that plastic device would exceed the benefits. And so this is a bad thing. When I see it, I think that's a very bad thing. And the other thing that we can never completely eliminate is that humans make errors. Now let's say you have a second individual checking the first individual's work. As I said before, you probably don't want a duplication of effort, but even if you did have a duplication of effort, there's a potential that two people will make the same mistake. I see this on exams all the time. I'll have two individuals, now they aren't copying of course, but two individuals will answer the same question wrong and they'll choose the same multiple choice answer and it will be the wrong answer. So having someone else check over the work, it isn't going to prevent all that human error. And then you have fraud. You can do your best to prevent shoplifting, for example. You can put all the cameras up in the world, but everywhere have cameras. But still, the individual is going into the dressing room and they're going to have their privacy. They're going to be trying on garments. And unless you have a camera in the dressing room, which I wouldn't suggest anyone should do, you're not going to catch all the fraud. You're not going to catch all that theft.